This one is 45 minutes, I think. We should be good for that. EIF Impact Investing Market Pulse. So there's a survey, and we're going to hear all about that. Oh, was that a kind of a team moment there? Oh, I thought you were doing a fist bump. Oh, my God. So can you please, that was great. I thought, wow, look at that. They're a team. Can I please welcome the team to the stage? We have Adelaide Cracco, who is head of Greentech and Social Impact Investments at EIF, and Cyril Gouiffes. Look at that. Class, Katrina, head of Social Impact Investments at EIF. What's the starting point? What's the survey? What are you telling us about? I think it's okay. We're all good.
We really thought this would be an ideal moment, to sort of pause, reflect, and as well as get to know each other better, really know how we can do better, and that includes the EIF. So we decided, in the run-up to this event, to run a survey amongst our impact fund managers. Again, to gather, market sites at a very critical moment, in time where we're thinking about new financial instruments, new programs, and so we think that really the views, of the investors that are at the front lines of the impact market are invaluable. And just for a little bit of context, we sent the survey out to over 95 GPs. We got about 85 responses, and that represents about 70% of, again, the impact investor community that we sought to reach. So we think that's a really good turnout, yeah.
Here's a question. Did you have to chase anybody up for the...
just a little bit, Sometimes emails get lost. You have to bring them back to the top of the pile, but yeah.
And people in this room answered that survey? Is there anyone
yes.
in the room?
Yes.
Who in the room was a part of that? Okay.
And we're very thankful, yeah.
Perfect. The floor is yours. Thank you.
So here we go. So I guess the first question we had is, what does our community actually look like? And that was actually the first question, which is, what is our impact experience? As we know, the impact investor landscape has changed quite significantly over the last years. If we look back 10 years ago, it was quite sparse, and it's only really over the last 5 years that it's taken off. That means that basically the impact VC firms that are operating in the market today, most of them, have less than 10 years of experience. This is not to say, however, that the teams working within these VC firms don't have experience. Actually, many of them have backgrounds in venture capital, in private equity, as business angels, or as advisors in the corporate finance sphere, and they are bringing that vast wealth of expertise and experience to impact finance. Now, if we look at for example, the investors that have been here for over 10 years, what we'll find there are a few of the clean tech investors that survived that first wave investment, back in the mid-2000s, so very brave, as well as, pioneering social impact investors that we heard from earlier, many of whom were supported by our Social Impact Acceleration Program. So the next question we wanted to understand is, what issues we're addressing. And I would say also in the early days of the impact investing market, we found more generalist impact investors. This has changed. Again, over the last years, we're seeing increasing specialization as well as a distinction, as we heard earlier, between social impact and climate and environmental impact. If we look at the graph, again, the number of investors looking at climate and environment is, proportionally more important than in social impact. This is also what we see on the market in terms of the fund proposals coming to us. We also see more climate and environmental investors purely focused on those themes, whereas, in the, I would say, in the social impact investing space, there are slightly more mixed and diverse strategies. We're paying a lot of attention to this because, although I think all of us here can agree that climate and environment, is still an underserved market, and it deserves our attention given the challenges we're facing. We do want to make sure, however, that we continue to address fundamental social issues, which, again, are very much intertwined with climate and environment.
Thank you. So you can hear me? Yes, thanks. So continuing and trying to assess who we are, and again, making the most of your presence and in this room. So this slide here and this graph here is, I think, has to do very much with the core definition of what impact investing is, meaning that impact investing remains in the first place an investment that seeks to back, support, grow, and scale companies that are designed to solve a climate and social issue, next to obviously growing and generating financial performance. So this is something you do very much at the early phase of the development of a company. So that's not so surprising to see that most of you here are focused on the pre-seed, seed up to Series A financing stage. It's something that I think features quite significantly impact investing. That's also very much or very intimately linked with the start of the impact investing activity also at EIF. I mean, we felt, and under a team effort, a joint effort here, but that venture capital was certainly a strategic segment to start off. Doesn't mean that is restricted to, obviously, and also in the room, even though the vast majority of the audience here is focused on early stage financing, startup financing, there are also growth-focused investors. And I think that also says something about the maturation of the market, the financing needs of natural-born impact players, so to say. So a token of a good sign and maturation of the market, sophistication of the market. On the next slide, thank you. Next to at what stage do we finance, where do we invest, and where does your investment capacity actually goes to? It's a discussion we often have with our stakeholders, mandators, and counterparts as a whole. This market is fairly skewed towards Western Europe, and especially France, that is here quite overrepresented. Pleading not guilty, don't listen to my accent, please, but that's simply a mere reflection of the deal flow we're getting. And so we are always obviously we are mindful of this is a pan-European, this is a central mandate, so that's designed to serve the EU as a whole. France, Germany, Netherlands, Spain, Italy. Spain, we heard it also earlier today, is definitely gathering the majority of the investment, or at least that's where most of our impact GPs are based. And now if you look where, that obviously has consequences on where do these GPs yourselves invest. Again, Germany, Nordic, Spain, France, Netherlands are countries that you see here on that heat map that seem to come out quite a lot. There is, though, I have in mind one fund manager that we've supported that's based in Croatia, so obviously that did not take the survey here. So again, it's something that I would say we do not, but is here, is in the room. And most importantly is making sure Croatian impact companies get served. But joke aside, when there is perhaps, because of the sophistication levels of the ecosystem, a more natural deal flow that comes to us from the countries I just named, additional efforts need to be done to make sure we have a well-balanced geographical outreach as well. And this is something we do. And actually, this is perhaps one of the very distinctive elements of how in the last 5 years, at least one investment manager based in Central Eastern Europe has been backed every year, at least on the social impact side of our activity.
And increasingly on the climate environmental side, yeah. Mm.
So, moving on to challenges and needs. Yeah.
So, of course, we also wanted to understand, from the market, what challenges that you have and what are the needs that you would highlight. So one of the, topics that we wanted to hear from you on was, where we should be placing more attention in terms of themes or verticals. So we asked you to select and vote, on individual topics and themes, and then we aggregated the responses by major thematic category. And if we look specifically at climate environmental impact, it would appear that climate mitigation continues to concentrate, our focus. But actually, if we break out, again, these categories into the individual themes, we see that new strategic themes are emerging, beyond the clean energy transition. These include the circular economy, industrial decarbonization. Both are very much tied, to transforming, really fundamentally transforming the way we, produce, manufacture, distribute, consume goods and services. And so it seems that this is garnering more attention. Climate adaptation, up until now, has had very limited VC investment, but I think all of us here today can recognize that climate change is here, and we need to learn how to manage it and invest in technologies and innovations that can help us be more resilient. And then after that, agriculture and food products, so again, a very critical and strategic industry that needs to become more sustainable, but as well as more efficient, resilient, and productive in the face of climate risks, but also in the face of geopolitical risks, and again, is getting also attention because of issues of dependency and sovereignty.
On the social impact side, on social innovation side, for those of, we're all here familiar with what this market looks like, and so this slide here is not that surprising, but a couple of points to mention still. Education and healthcare make up for the vast majority of the thematic focus of social impact fund managers. As is represented in this graphic here, it's really pretty striking, especially on the left-hand side of the slide. Then you have still this pink bar there that says social and economic inclusion. That is the biggest. However, also covers a very wide diversity of sub-thematics that can range from employment down to migration and other thematics. I'd like to also mention especially the fact that thanks to you, Guillaume, and this great initiative, we are supporting the first migration-focused fund in Europe. So we are seeing plenty of thematics that are still underserved, or at least not as systematically addressed by impact investors. And we see it's only a matter of time thanks to, again, front runners that we appreciate very much. Also fair to say that it's interesting to see if you look at the right side of the slide here and also on the histogram, the Sinus histogram there, that healthcare has always been a very important thematic in the social impact space, but here, well-being and mental health actually rank higher than access to healthcare. And this is something pretty new. I don't want to over-interpret it, but it's perhaps also the sign of the post-COVID period we live in, and something still there is an evolution to witness beyond each of these main thematic here. Finally, the last two on that part of the slide that are also very important matters, culture and media are also very powerful thematic to push the social impact agenda. And again, perhaps a call for all of us to never forget about the first days and the founding fathers and mothers of this asset class or investment strategy, investing in fields that are perhaps overlooked by mainstream managers, but that do yield very intense social innovation potential. That would be it.
So what are the main challenges and constraints faced by our impact investor community? So fundraising, as we can see, really appears to be the most important challenge. Looking into our own data, what we've ascertained is basically fundraising periods are getting longer and longer. Currently, on average, our impact fund managers are taking 18 months or more to close their funds, and this trend is actually growing. And so this really differs, with the norm back in 2020 when most impact funds were closing at around 12 months, which is, sort of the legal subscription period. We're also seeing that many fund managers are having to close their funds at a suboptimal size in relation to their investment strategy, falling short, by 20 or 30% of their target size. So again, this highlights how difficult the fundraising environment is. After fundraising, regulatory complexities and reporting were also considered, an important question. And we know that impact disclosure and transparency are really an absolute must if we want to avoid greenwashing. But also the burden and cost of reporting can't be ignored. And it's particularly heavy, for first-time emerging managers, small startups, and so it's something also that we have to keep in mind. And we know that the difficulties, of regulation are oftentimes compounded by sometimes a lack of clarity, as well as the ease of application, again, to innovation and startups. Ranking third and fourth, we have two topics that are essentially tied together. And we heard about it earlier, the need for exit routes and acquirers, and also evidence of financial returns. As a market that's still in development, we realize that there isn't a long history or long track record, in terms of performance. We are also witnessing a general slowdown in exit activity, which is, again, common to the whole VC and PE industry. But we also heard from some of you that maybe, there is a reflection to be made on the expectation around financial returns if we, want to realize true impact. So actually building on this point, we wanted to put a question to the crowd, which is, are financial returns a general problem for the VC industry or more specific to the impact market? So this is a Slido. If you use your mobile phones, you can...
We need you here.
Yeah. And if you want to, engage and participate,
We want to make sure that next to putting a market when you register, there's also a live market feedback for today. And perhaps if someone has something...
It's still moving a little bit, I think. Maybe we can... Yeah, still, but I think we have a winner. No, it seems like although more the impact market's starting to climb. Okay, it looks like it's stabilizing a little bit. So it seems to be a general issue across the VC industry, but again, I think we can't ignore that 40% of you think that it may be more specific to the impact market. And again, we don't know if it's because, of the general maturity of the market, or if there are other issues that we might want to dig into. Maybe if somebody responded more specific to the impact market, would you like to participate and say why you think so? I don't see any hands raised, but yeah. Okay, we have a volunteer, yeah. Yeah.
Thank you.
Yeah, so I agree that the VC industry in Europe also has some issues with returns benchmarks, but the impact industry is even younger, right? Yeah. It's only 10 years, maybe 15 for us who've been around longer. So, and VC just takes a long time.
That was our conclusion too, but we wanted to see if, So, again, I think there's still, a time ahead of us to prove, but I think all of us can agree that the evidence of financial returns is important to attract LPs, and again, prove that these business models, work.
I could, Michael, I could add another one, which is clearly VC industry itself has good statistics through Cambridge Associates and others. And I think nobody kind of knows what quite to do with the impact funds to produce returns. Probably EIF has them. But it's often an unknown for investors as to, is it a separate pool or is it part of the main group of investing activity with respect to returns in terms of vintage and sectors?
From our standpoint, actually, again, the portfolio of impact funds that we have is still relatively young. So again, we don't have statistics to show just yet, but we hope soon to be able to do so.
I think that also still resonates with a comment that was made earlier and that we see. And so it's not a matter of not being able to deliver, it's a matter of also having the right time scale to assess the quality of an investment. And certainly having more patience would be important, even though, same as Europe is, same as the VC landscape is, we do have, we're happy to have in our portfolio funds that have already returned capital to investors. We have funds that are in the process of doing so. But there seems to be a pattern around resilience and timing still.
One last point probably as on the VC industry, has it overpromised on returns and not delivered in the end what they were saying?
Mm-hmm. So that's certainly a lesson for our
Actually, we have a
community.
colleague that can answer that, and he'll tell you that the returns are there, but that I think is another discussion. Yeah.
So next question was again that you kindly shed light on around the main funding gaps, the perceived funding gaps in your view across the industry. It's interesting to see that you are as financial, as impact investors, early stage investors, you still deem equity as being the main sought after financial instrument for the industry. And so that certainly makes a lot of sense. That is, to some extent, also counterintuitive to the fact that we are seeing more and more teams populating the market. We are seeing more and more equity financing actually being available. Doesn't seem to be enough. So we're working also to next time in partnering with you to make sure there is, again, commonly referred stable source of funding for our activity, and that's certainly one of our main driver next to our stakeholders. Aside from this dominant equity financing bar, you find a number of interesting elements: project financing, guarantees, financing loan, debt financing altogether, venture debt, outcome contracts, which also represents or seems to call for the need and a wide variety of financial instruments to be able to best address the needs of impact investors, of impact entrepreneurs, and give them the means to scale actually their solution. Interesting also to see that at the bottom you still find a meaningful 26 and 20 of you also pleading for grants and subsidies. We hear a lot lately about systemic investing and how equity financing cannot do it alone, and it does live in an ecosystem, a commonly referred to name in our business, ecosystem. But ecosystem also implies different time scale, different return expectation, and all of this seems to be necessary to coexist so that for the greater good.
So really our conclusion here was that equity financing is still a huge funding gap, but we need many more diverse financial instruments, as we heard. Jerome,
Wonderful. So Jeroen Kelder from Infinity. One question. So for us, this is quite important, the additional funding. So we see ourselves as a catalyst. We're effectively accelerating the transition to a circular economy. So I would say, and it depends how you look at this, but equity is effectively the accelerator for the other sources of financing. And it's therefore not only important, necessary for equity to go first. So that's why probably it's on top of the list. But it's also important to be sequentially first. In other words, if we start with subsidies and grants, and we've seen that in our industry, that actually sets the wrong discipline for a lot of those startups. So you need to kind of come in with equity, and then indeed leverage the equity and what comes with the equity through grant funding and other non-dilutive sources of financing. So I think it's important to kind of make that distinction.
Yeah.
That's an interesting reflection. Thank you.
So here also we wanted to get from you what are, in your view, the main missing financial structures on the market. So still calling for dedicated impact fund of funds seems to be also the right answer to hold the needs that we have out there. Perhaps also important to stress the fact that these are impact fund of funds, so really facilities that are designed, dedicated to address and meet the needs of pure players, so to say, or at least investors, GPs, who have a clear strategy, a clear theory of change towards achieving a balanced financial performance, impact performance. Next to it, growth fund is something that also came up in the earlier question. I mean, the impact investing community starts very much and acts very much on the early stage of the company development, but also for the industry as a whole to pick up, for the company to continue scaling, there is a need for more growth funding. Also important to scale, and we've heard that, and certainly that's something that will be at the heart of the discussion for the years to come, and making sure we design the most appropriate financial instruments. Patient capital, I mean, there are also certainly lessons for us to be learned. Impact investing was born, let's say, in the VC coffin, so to say. And perhaps looking at the time horizon of a traditional VC fund, compare it with an impact fund is a relevant question to ask, and ask also ourselves if it's something that could eventually evolve or become differentiated over time. Secondary funds also calls or resonates very much with what we heard around the necessity for liquidity in this market, the necessity of bigger exit or more diverse exit routes, and especially more active acquirers on the market. Then specialized thematic funds are still obviously very closely linked with having a sound value add on the entrepreneurs we are seeking to support.
So we also thought that this would be a good moment to ask you how we are doing, and how happy you are with the EIF's products and what features you would enhance if possible. So it appears that although people are, our investor community is still, generally satisfied, there is some room for improvement, because 57% said adequately rather than very well. Thankfully, nobody said poorly, otherwise we would have lots of explanations to give. But if we look at the features that you would like to see enhanced, clearly larger commitments stand out, and we think this is, again, very closely linked to the fundraising challenges you're facing now. Many of you have asked us to reinforce our roles as anchor investors, and again, we would like to continue, with this mandate. Another 53%, highlighted that you would like our investment processes to be a little bit more streamlined. Our reputation, both fortunately and unfortunately, precedes us here. We do know that our processes are long. They're also very diligent, and we think that ultimately works in favor of the market. But we do take on board that there is a bit of streamlining to do. Close behind this request, we have the ability to exceed 50% of fund commitments. Again, very much linked to fundraising challenges. It's something we can do under specific mandates, but not across all our investment programs. And it can really be helpful in terms of getting a fund off the ground. And again, going back to what Cyril just said, we are also seeing a demand for more patient capital. So again, greater fund duration and potentially evergreen structures. So we're listening. Mm-hmm. And we also asked you an open question, so what specific recommendations or suggestions you would have for us. Thank you again for providing that feedback. We haven't been able to put everything up here on the slide, but rest assured that we are going to be digging into every single recommendation. I think I would single just one out here, and again, we've heard it in the previous panels, blended financial instruments, that can really leverage public resources, in order to attract and mobilize more capital from the private sector. We heard from you that, maybe first loss pieces or asymmetric return models in favor of private LPs might help. We also heard earlier that we need to find ways to move, the giants, and this requires a little bit more creativity on our part, new financial instruments, and again, different ways of building public and private partnerships. And so this begs a question, Cyril, right?
Exactly. Be mindful of your response. That may have significant consequences. You've seen who's in the room. But basically, if you were to be asked what would help you better catalyze private funding, wider diversity of funding, would that imply, in your view, EIF committing larger commitments on pari passu terms with other LPs, or to the contrary, smaller, lower commitments, but with or providing asymmetric return to other LPs?
And downside risk protection,
And downside
which we heard,
yeah.
The risk aversity, yeah. No.
No, but this is not an open question. Yeah.
It's evening out.
Wow. Let's recount.
I hope no one's voting twice, huh?
Yeah.
Okay, it's almost half-half, no? So this is interesting, yeah. Yeah, okay. I think this will give us food for thought, certainly, no? And again, maybe it is a combination, Uli, so something to reflect on.
Perhaps someone want to also share his view on why that answer or this answer, but not a must. If you feel like, please take the floor, otherwise we simply continue the presentation.
Okay, well, we'll leave then the discussion.
Noted.
Nobody dared.
So then we would move to the last section of the survey, which is our approaches to impact, and obviously a very distinctive feature of our business, and certainly that is one that is close to our heart. We do hear often about how painful impact measurement can be, how much of a hassle it is to report and compile. But leaving this consideration aside, I think we all agree that we cannot afford not to measure our impact in a strategy that is coined impact investment. So that's a very serious one. We spent some time this morning also discussing the matter. Important one. Thank you. So certainly the entry point for this thematic of our approaches to impact is starting with the SFDR, which is certainly the most relevant regulatory entry point for our industry. It is not the alpha and the omega, but it's certainly a very important entry point, and curious to hear first and foremost from you, who registered as Article 8, who registered as Article 9, and we have a clear majority here, Article 9, 72%, which is perhaps not surprising. Article 9 is supposed to be here to actually create accountability or create a setup where you set a target to yourself and those targets are closely monitored and see if they are eventually met. That comes together with another slide or question, actually, that we would be curious to hear from you. In case, so reducing the sample here, but in case you're an Article 8 fund, what is the reason why, or what are the reasons why you decided not to go for an Article 9? We'd love to hear from you.
Yeah, and we have different responses, no?
Yeah. Either too costly, difficulty of data collection, reporting as a whole, or perhaps because of the taxonomy. We have obviously a discussion around the climate taxonomy, the social taxonomy that also have different timescale and lending. Any other that you deem relevant? Or perhaps you closed before SFDR was available. Okay. So the first one here is interesting because that's also certainly has to do with the topic that we mentioned this morning, that let's say in the approaches that we or ask our partners to implement, like there is one very important element that the KPIs, the impact indicators that we ask you to monitor should be very closely linked to the business. So on the one hand, there is one obvious content reason for that. I mean, you want to report and be accountable on the alignment of interest if and only if the indicators that are retained are eventually very closely linked with the business model of the company. We heard that. But also, obviously, that the positive externality of this approach is also that's supposed to be easier to monitor and easier to handle, because this is basically core to the impact company. So, yeah, I think there is certainly reasons around the availability of data here in the SFDR regulation that certainly can be a topic for further reflection. Thank you.
I think we jumped a slide. Okay, there we go. So again, we know that there is an increased need for disclosure and reporting, towards LPs and investors and regulatory bodies. But what are we measuring exactly? So we asked you, what are you looking at in your portfolio companies? And so the vast majority answered positive impact and outcomes. Only 16% are actually measuring the net positive impact, and so adjusting, positive impact for negative, impact and externalities. And then another 3% are also trying to estimate the economic value of impact. So our takeaways from this graph was, again, it's probably because the market right now is skewed towards early stage ventures that haven't really met those investment, or rather activity and financial thresholds needed, to disclose, negative externalities, or they just don't have a big climate and environmental footprint. But as we heard, I think from the audience, earlier today, there is a huge opportunity for early stage impact investors to really shape the companies they're investing in, to really set the foundations so that they are, sustainable. They have sustainable and viable, business models over the long term with, true impact, and so again, there is an opportunity there. Then the other question we asked is, what frameworks are we using? So interestingly, 43% said their own framework, and 35% said the framework supported by the EIF. And no, we didn't take this personally. We actually concluded, and it was based on your responses, that those that are using their own framework are actually building on the basic principles and guidelines of accountability that EIF has been promoting over the years in the market. And the fact that a lot of fund managers have their own framework is a sign of maturation of the ecosystem. It shows that they've been building on these guidelines, further sophisticating the framework and adapting it and tailoring it to their investment strategies. And and so we think this is healthy, but again, it brings a lot of diverse perspectives and potentially a lack of harmonization. And then another question is, who is evaluating and assessing the impact? So what we thought was fantastic to see is that most of you have in-house impact and experts. This wasn't the case a few years ago. This means that impact is really embedded into all aspects of your strategy and operations, from initial screening, investment analysis, monitoring, and management. So we think this is a fantastic development. And some of you are also using external experts and consultants, to set or measure KPIs. It's not yet a majority, but some of you are referring to external experts. And this actually brings me to impact accountability. What we're increasingly hearing in the market is, how do we verify impact results and outcomes? And many LPs are asking this question, as well as, again, regulatory bodies. How do we ensure that impact outcomes are well reported? And I think we talked about it earlier, whether there is a need for third-party external bodies or experts, to again verify the results. Currently, not many of you are auditing, but still, I think that number is growing, over 40%, which is significant. In terms of impact accountability, and this is also really good to see, 94% of the impact investor community is linking, again, their carry and their performance incentives to impact achievement. That percentage can vary. But again, what we're seeing is in the social impact investing market, most fund managers are, tying 50 to 100% of their carry to impact performance in addition to financial performance, whereas in the climate environmental market, it's probably, the range is more 30 to 50%. All ratios are meaningful and again, ensure a very strong alignment of interest, across the stakeholders of the fund. So.
Yeah. So they obviously don't take that as a nudge. I mean, it is a question, but we obviously also have seen the maturity, and I think we recall that the very first due diligence that we had back in the days where we said, well, our commitment will be subject to you being open to make your carried interest subject to impact performance. We heard very often, you're playing with the alignment of interest, that's dangerous, and that may be ultimately very detrimental to the industry. I mean, it turns out that is now, even outside our intervention, it's become somewhat of a consensus across the industry, so I think it's very promising. But should, in your view, the impact that you're generating, that for now, and we discussed this morning, is validated by the LPAC, should they be audited?
So here goes the drum roll. Interesting. Okay.
They say, careful what you wish for.
Okay, I think,
Yeah,
I think the majority is,
Interesting to see again, pretty balanced, but still, yes, seem to be also for the benefit and joke aside around what it represents, around also the sophistication of the market infrastructure that is required to make it happen. I think that also says a lot and would be a major step towards making, impact investing or the impact performance unquestionable and blessed, so to say, by a third party. We know, many equivalents on the financial side. So there are few reasons ultimately to figure or expect that that would never happen to the impact figures as well. Thank you for participating. These are the last two slides of this presentation. Also looking at you, Katrina, hoping that you will like the timing. But interestingly, that also resonates pretty strongly, these results that I'll let you look at them and take knowledge. But it's interesting to see for the majority of the respondents, 61% know my impact carry linkage does not alter my investment behavior. And for those who have replied or answered, yes, it does. The reason for that is that because we place impact really as the first paramount objective of our investment strategy, and therefore it does alter, but forces, so to say, to continue making sure we look at the most impactful companies out there. Again, I think, and I don't want to overdo it on the accountability that we've heard a lot already today, but I think it says something around a validation of the approach we had back in the days, and that also you brought to EIF, Uli, that the core objective at the time was very much to, on the one hand, come up with a seamless process, with a process that does not require to hire four full-time equivalent to simply look at the impact in already small teams. So seamless, relatively simple process or mechanism to put in place, next to a mechanism that also does not interfere with the investment decision of fund managers whom we know are impact-driven managers looking for driven entrepreneurs. So that's also a very strong feedback from you and a very strong validation, I find, of the approach that we took back in the days, more than 10 years ago, and that is basically now yours or ours as a community. I'd like to say also that, interestingly, again, that reminds, all the warnings we got back in the days and the call for being cautious. More and more we hear that actually an impact manager tying its carry to impact performance, makes to financial performance, is also seen as a USP. And for many, including in the competitive financing rounds, when you have one of these LPs around the table that would be very happy and thirsty to back your company, if you know you have one whose own personal incentive is also tied to making a strong, tangible, measurable impact, becomes a USP, as opposed to an issue or a detriment to the strategy. Final one, that is hard to conclude with, actually, but it's like one of the questions that shakes our industry, return ambition or return expectation, return as in financial return. 84% of the audience here, of the GPs, believe that impact funds should look at exactly the same financial performance as any VC or private equity fund, which is interesting. Super consensual type of answer. Still, 13% of the audience or the respondents also said, I'm ready to go for a single-digit return, a high single-digit return, or low double-digit one, because I consider that I'm here to maximize the impact. And so that leaves us, I believe, with the one very central question, which is also has to do with several industry surveys we can find. The GIN report was released not that long ago, and there is always a recurring question in all GIN reports that says, slightly different from this one, because it says, did the financial performance as an impact manager, was it in line with your expectation, or did it outperform your expectation? And this year, 94% of the respondents, of the impact investors, defined as such by the GIN, said either in line or outperformed my expectation. So then the next question would be, okay, but what were your expectations, obviously? So that only partially answers the question. But again, I'm living here on a question that I do not want to answer, but certainly would be keen to discuss, perhaps also on stage, off stage. But do you think that this question is actually fueled sometime by provocative talks you can drop here and there on the internet, Uli? But do you think that we can achieve real, tangible impact and provide this additionality to our impact of founders, entrepreneurs, while at the same time making or assuming no trade-off whatsoever on the financial side? I don't want to answer that one, but it's a question for you. But Lance, please, yes. Yeah, please. Thank you.
I was surprised with this question coming from the EIF because you according on what impact or what theory of change you want to answer, you can have market return fund in the same company, a market return fund, and next to it, a fund that only preserves capital, and this in the same company because you have various impact targets, and this with the EIF as an investor in both funds. So it all depends on what impact you want to.
Yeah.
Definitely, also resonates with the different sources of funding. We are using different stage when we come in for. We are sometimes exposed to the same company, but through a fund that invested 3 years ago and a fund that invested 6 months ago. So that's also certainly has to do with our own sources of funding and what type of policy objective they serve and strategy they serve.
Yeah, that the funds have. Yeah.
Yeah.
Okay. So,
Thank you very much. This is the end of this presentation was. I hope you enjoyed as much as we did.
Yeah.
That's great. Just one. I'm seeing you back right at the end for a
Okay.
super. But just one quick. Any surprises in the poll results for you? Were you surprised by anything?
Actually, there were quite a
There-
few, no?
were
I
there?
would say,
Yeah.
Cyril,
Yeah.
both
Yeah.
in terms of themes that were highlighted, the
Okay.
types of
Yeah.
instruments that the market's asking for, also the audit outcome, I think.
Yeah, in the live results. Yeah, that was a
Yeah.
surprise.
Yeah.
Okay.
The live
Just
results
good.
were full of surprise.
Yeah.
Yeah.
It was a bit of a surprise.
Yeah.
Good ones?
Yeah.
Well, giving you some
Yeah,
work.
good ones, obviously, good ones because that's always we are always dealing with these matters in a dialogue. So for sure, that's for us knowledge and good surprise. Yeah.
And we think, I mean, again, thank you for answering the survey because the insights are very valuable and will actually serve to, again, feed the financial instruments and products and mandates that, we hope to design and ideate for the next investment programs.
Thank you.
Thank
Thank
you.
you very much.
Thank you very
I will
much.
see you shortly. Thank you.